Hi, I'm Josh Brown, and this is Surviving the Growth Stock Massacre. I'm bringing Nick Colas on in just a few. But first, I'd like to thank our sponsors at Betterment. Imagining a better future is the first step. Investing in that future with Betterment Advisor Solutions is the next. Whether you're launching your own practice, looking to streamline client onboarding, or just searching for efficient ways to scale your firm, Betterment is here to help. They automate to make tax optimization simpler, providing support to make administrative tasks easier. At Betterment, they're building innovative technology, all for anyone who's ever said, I think I can do better. So grow your RIA your way with Betterment Advisor Solutions. Learn more at betterment.com/advisors. Investing involves risk, performance not guaranteed. Okay, on with the show. Ladies and gentlemen, welcome back to What Did We Learn? My regular check-in with my friend Nick Colas of DataTrek Research. His co-founder Jessica will not be with us today, but we'll see her soon. Nick, I'm so happy to have you. It's a fairly momentous time. Let me just give you your official introduction and we'll get right down to business. DataTrek Research puts out the morning briefing newsletter. It goes out daily to over 1,000 institutional and retail clients. Nick is also one of the smartest people I know. And as I told him last week, one of the only people I absolutely need to hear from in a time like this. If you want to see Nick and Jessica's YouTube channel, we have a link to it in the description below as well. Let me set this up, Nick. In the first month of the Trump administration, stocks were trading higher in follow-through from the post-election rally, and everyone was focused on the deregulation and the extension of the 2017 tax cuts. This is what people were really excited about, and with good reason. Then the mood completely changed. In the third week of February, as the tariff announcements began, it was like Dr. Jekyll and Mr. Hyde. The trouble is, not only do we have this tariff situation, but we also went into it with way too much enthusiasm, according to your research. Why don't you take us through why that seems to be one of the biggest problems right now?
Sure. Let's just start with popping up the first slide, which is the State Street Institutional Investor Risk Appetite Index. Now, you know, State Street's one of the biggest custodians of financial assets around the world. And what they do is track how their portfolio manager clients are changing positions in a given month. And this graph shows you when they turn bullish, when they turn bearish. Stuff below the line is when they're bearish. Stuff above the line is when they're bullish. And you can see they were pretty negative in 22, got bullish in November 22. Awesome. That's the point, the first point on the left-hand side. Then they were pretty cautious through 2023, got more bulled up in 24. But what I've done is highlight when they get super bullish, when that number, when that index goes to its highs. And yes, they called the turn in November 22 perfectly, but they tend to get bulled up in the current bull market at exactly the wrong times, and we've highlighted those there. So July 23, they got pretty bulled up. S&P fell 8%. July 24 got bulled up. S&P fell 8%. Then in October 24, they got kind of bulled up, modest pullback there, but they were really in that really super bullish position at the end of January, and we're down. I had it 4% as of Friday. It's down probably 6 now. So we're seeing a pullback, but you know, big money was really poorly positioned for this. As you said, they got way too enthusiastic. That's problem number one.
Okay, I wanted to stop there and just ask you, when the institutions that whose data is being fed into this risk appetite index, when they get bulled up, what does that look like? Is that higher than average allocations to stock funds, or smaller cash balances, or some combination of the two?
It's a combination. Of late has been very low cash balances, very high allocations to the U.S., and that's been persistent for the last 24 months because of the American exceptionalism trade, American stocks doing so well. So they were really poorly positioned, both in terms of not having enough cash and being way too long the U.S. They were tiptoeing into EM at the end of the fourth quarter, which is a bit of that
China.
spike. China, exactly. Yeah. Europe was underexposed, and you know we'll talk about how wrong that was in the next couple of slides.
I had it exactly backwards. Well, you can understand, like late January, why you start seeing institutional investors getting bulled up. We really had a lot of momentum coming into the year, and if you were in the camp that says, "Okay, come January, this is all about to get real, and stocks are going to sell off," it didn't happen. Didn't happen until mid-February. So I think you had a lot of people just say, you know what, we got to get on this train. This thing's going.
Yep.
And that's how you get those higher than average institutional risk appetite readings. Everybody just decides they got to play.
Perfectly said. Yep. I have nothing to add to that.
All right, continue.
Next slide is S&P earnings. So this is quarterly S&P earnings. This is FactSet data. And you can see the dark blue lines are the historicals, nice steady uptrend in sequential quarterly earnings. But then we get to this funky downdraft in Q1. Now, by way of background, S&P earnings in a normal market, normal economy, they go up 2 to 3% every quarter. They're nice and pretty steady. There's not a lot of lumpiness. But we have this big downdraft from Q4 to Q1, down 8%. But then the street's expecting, and those gray shaded bars are street expectations, expecting 21% improvement in sequential quarterly S&P earnings through the balance of the year. That downdraft that you see down from Q4 to Q1, that's been pretty recent. That's been a bunch of companies in consumer discretionary, materials, energy, cutting their guidance because they're worried about tariffs. In fact, FactSet did some pretty good work on that in their last earnings insight report. So that bump is the tariff downgrade of earnings.
I mean, it's an air pocket.
It is an air pocket.
It's
an air pocket.
Okay.
It's dramatic. And like I said, normal times, you get 2% growth, 3% growth in quarterly earnings sequentially through the year. There's not a lot of seasonality there. It's the same from Q4 to Q1. So the market looks 6 to 9 months ahead of time. That's what markets do day to day. And right now, to get to those numbers in the back half of the year, you need a strong economy. You don't get to record high S&P earnings if we're in an air pocket in the economy. So that's why the market's so twitchy. We don't have a lot of near-term earnings visibility in Q1 and Q2. This is entirely a back half of the year story. That's why you're seeing outsized volatility, because the shape of the U.S. economy in Q3 and Q4 right now is a big question mark on it.
So let's throw that back up one more time so I can ask you. All right. So for those listening who aren't looking at the chart, it looks like the last reported quarter we have $65.77 for the S&P 500's earnings. And now the estimate for this coming quarter is a pretty steep drop off. After 4 straight quarters of earnings growth, now it's looking more like $60.57. And of course, that's an estimate. It's not actual. We won't know for a couple of months what it actually turned out. But that is a fairly large air pocket. But then nobody really seems to be cutting the Q3 and Q4 number to the same degree.
Yep.
So am I reading this right? The street currently is expecting 21.1% growth from Q1 through Q4.
Correct.
That's a lot of earnings growth baked into expectations, to your point.
Yes. Now, to be fair, the street has been very good at calling the last 2 years of earnings. They were within 2 to 3% in terms of where they started the year on a number versus where it actually came out. So we can't just fade the analysts automatically. But this does explain why we're getting this choppiness right now, because we're relying on the back half.
So it sounds like one of your big points here is we have a way too enthusiastic multiple going into this problem at 21 times forward. That is not what you would expect the multiple to be if there's this much doubt about the next quarterly earnings report that is going to start in April. We'll start hearing about these Q1 numbers. So it's like there's just not enough doubt built into that number. Is that the biggest point?
Yes.
Okay.
And it's not just valuation; it's also volatility. Volatility is an expression of uncertainty about the future results. When the uncertainty is higher, that vol has to be higher, and we're seeing that now. We'll talk about the VIX in a little bit.
So it seems like the current expectation then is for a 1 or 2 quarter blip as either companies adjust or the administration pulls back on some of this stuff, or some combination of those two things. What kind of multiple do you think we would need to de-risk to account for an earnings drop off of this magnitude? If it looks like it's going to be more permanent, is that an 18 or a 19? Because that's a really big de-rating.
The 10-year average for forward 12-month PE multiples is 18.4.
And we're 21 today forward?
And we're 21 today, but let's keep in mind that 18 includes a lot of bad crap that happened in the last 10 years and much greater levels of uncertainty than we have right now. So I look at 18 as a floor. 18 to 20, I think, begins to be fair.
Okay. Here's some potentially good news away from the U.S. stock market. The multiples might be too low given some of the things some of the recent developments. And you guys point out DeepSeek, some potentially positive government vibes for Chinese large cap companies, tech companies that were basically in jail up until this past fall, metaphorically speaking, sometimes literally. And now the Germans are going to rearm for World War III. So that's a fairly material mentality shift taking place there. Is that enough for investors to offset this earnings air pocket we're going to experience here in the U.S.?
It is more a kinetic response, I would say, to what's going on in the U.S. because, as we all know, the returns outside the U.S. over the past 5 and 10 years have been terrible. The U.S. has just cleaned the table with all these other equity markets. And now you have some small catalysts. You have President Xi shaking hands with Jack Ma saying, okay, we're not going to persecute tech founders as much. You have DeepSeek proving that China is not brain dead on Gen AI. And as you said, you have Germany really thinking about the most dramatic shift in fiscal policy since the unification of the country in 1990, wanting to spend on defense, but also on infrastructure. And by the way, talking to my contacts in Europe and seeing some of the surveys that have been run, these are wildly popular initiatives in Germany, so they should pass. Germans are tired of aging infrastructure, slow economic growth, being beholden to the U.S. for defense. And so there is a broad social support for these measures. The catch is that it's all going to pass by March 25 because the parliament changes on March 25. The outgoing parliament is still more likely to vote for these measures than the incoming parliament. So there's a very short window to find out if this catalyst is actually true. But the point is, you have sort of fiscal cutbacks in the U.S. and fiscal expansion in Europe. And that's why Europe is outperforming so dramatically year to date.
Let's throw that table up. So here's KWEB, the Crane Shares Chinese Internet ETF, up 26.5% year to date, which is blistering, up 48.5% over the past year. So for a lot of people, these were no-touch stocks. China was considered dead money. Well, good morning. It's a new day. The triple Qs, the U.S. growth trade, let's say, the NASDAQ, negative 3.8% on the year. And that's, I think, going into today. So today will make it worse. So that's a pretty big spread between KWEB and the triple Qs of plus 30%. And then what you're saying something similar now is happening with European stocks. What are we looking at here?
Yeah, so the point of this table is just to show like the 3, 5, and 10-year CAGRs, how much these things compound was dramatically in favor of the U.S., the Qs or the S&P 500 versus KWEB and MSCI Europe. So you look at the 3, 5, and 10 disasters, right? Now you've got people saying, you know what, maybe they're cheap enough. And I'm not getting the U.S. level of entrepreneurship and growth, but I don't have to worry about big fiscal spending cutbacks and tariff uncertainty from the U.S. side. I do have to worry about it from the European side, but maybe these things are beaten up and now there's a catalyst. You have the catalyst in China and you have the catalyst in Berlin. So we'll see how it plays out, but that snapback trade is clearly working.
I want to show you, I brought a chart for you. I didn't know this existed until 20 minutes ago. This is the Select Stocks Europe Aerospace and Defense ETF, EUAD. Nick, they really got one for everything. Versus the iShares US Aerospace and Defense ETF, which is ITA, which I think most investors are at least aware of. Look at this performance differential. The European Defense ETF is up 36.55%, and this is year to date, versus the ITA, which is Boeing and then all the defense contractors, up 1.6%. Have you ever heard of this ETF?
Actually, sadly, yes.
You have? Okay.
Yes.
I had it. Let's put up the table. These are the top 13 holdings, and I think these might be all of the holdings. Because Airbus is 21%, Safran is 19%. Rolls-Royce, which does not make the cars, Rolls-Royce sold the auto business to BMW. They just make the jet engines and nuclear stuff, is 13% of this index. BAE Systems is a fairly well-known British defense company, aerospace company. And then this Leonardo, which is 4%. That's an Italian defense company. I don't know. You must know these names better than I do.
Well, the one you skipped over, Rheinmetall, has actually been the spiciest, I think.
I only skipped over it because I can't pronounce it. But tell us about that.
It is a German defense manufacturer and
Okay.
has had this amazing rip over the past couple of weeks. And it was
Yeah.
considered a value stock and like very attractive at the middle and end of last year. I got it pitched to me. And then all of a sudden it's just, I hear it again 3 days ago and think, wow, okay, that was a good call.
I want to point out that, yes, this index of 13 defense contractors based in Europe is up 36% year to date. But these stocks effectively have done nothing for 10 years. And it's not out of the question that they could be up another 36% if, for example, that parliamentary measure that you mentioned passes, or something worse happens on the Ukrainian frontier. Like, it's not out of the question for this rally to endure throughout the course of 2025, depending, I guess, on how confident you are that Europe is truly awakening to its own need for self-defense, or how bleak you think the geopolitical situation will become, let's say, by this summer, this fall. So you would agree that that's kind of like a rational way to think about if you wanted to get into some of these stocks now?
Yes. I mean, look, the easy trade is obviously over. And now it comes a question of, does this measure pass by March 25th? And then how much does Europe actually use the capital sensibly? Because, Europe is a place that capital has gone to die over the last 20 years. It has not been a good market since the financial crisis. Some of the charts on European in single countries are flat since 2008. So it's not been a great trade. So you really have to have a high degree of confidence that they'll do something sensible with the capital after a long history of not doing so. But the call really is, are the European countries now shaken up enough by the change in policy from the US that they are comfortable deficit spending? Germany says yes. But then are they also comfortable actually allocating capital sensibly and fixing some of their own internal problems as well? And that's to be to be determined.
We don't know. All right, last thing on this. You point out a lot of U.S. equity rotation has already happened, making it harder to judge what to do now. This is like a perennial problem for investors. Like, by the time they figure out what's going on, they may have missed whatever opportunity there was to capitalize on it, which is why most investors are better off not trying to chase index and sector rotation. But talk us through this.
Sure. It's I think the next chart. Yes, this is S&P 500 consumer staples minus technology, 1 year trailing relative returns. And what it shows is that staples usually underperform technology over any given 1 year period. This chart goes back to 2015, so it's a 10-year time slice. And most of the time, staples underperform. No surprise. Staples don't have the fundamentals. They don't have the growth. They don't have the technology. So cool. However, there are times when staples do outperform, and that's when things get really bad in the U.S. market. So the biggest period was 2022, the rate shock. Despite the fact that rates went up, staples did really well relative to tech. Tech got creamed. Staples did a little better.
Yeah.
Staples have just come off of their worst level of underperformance this in the last 10 years at the end of 2023. And they've spent the latter part of the most of the last year recovering. And now they've actually outperformed technology over the last year. So a very unusual situation. So if you're going to get into staples now and sort of avoid tech, like you said, you've missed that move. That was a 2 standard deviation downside move. And this, I think, contributes to equity market volatility, because a sensible investor will say, I can't be in tech, and staples have 2 to 3% growth and are trading at 23 times earnings. I can't go there. So I'm just going to sell down the entire market. And that's what creates the higher correlations between the sectors and higher overall index volatility.
Yeah, so I think this is a really important point, because over the weekend, the lead feature article in the Wall Street Journal for, presumably the investor class is reading over the weekend, what do I do now? And the article is called Stock Investors Go on Defense with Dividends. And they point out the most popular dividend ETFs. For example, SCHD, which is the Schwab US Dividend ETF, is up 4%. The S&P Dividend Aristocrats Index is up 3.5%. This is on the year. And the S&P is negative. And here's an example of one of the charts they put up. Here's Johnson & Johnson and Coca-Cola versus the S&P 500. But I was just thinking when I was reading it, I'm like, oh, this feels, I don't know how late. I don't know if it feels totally late, but it feels somewhat late that this huge rotation has already taken place almost in the blink of an eye. And now we're gonna start telling people sell tech, buy candy bars. So I just looked at this as kind of like, this would have been much more helpful if you published it 10 days ago and not over this weekend
or a year ago.
Well,
when nobody would have printed that.
Now we're asking a lot. You wanted to wrap up on a little bit more of a positive note. Tell us what we should be thinking about here. This is really good. People should screen grab this thing.
All right, let me just go through it for people who are listening. So the title is When and Why Bad Things Happen to Good Markets. And let's just start by accepting that U.S. equities over a very long period of time have done very well for investors. So since 1928, which is 97 years, the S&P has been down more than 10% on the year, only 12 times on a total return basis. So 12 times out of 97, basically 12%, we've been down 10% or worse. 8 of those were due to recessions. So 1930, 31, 37, 57, 73, 74, obviously, 2001, and obviously 2008. 3 were due to World War II, 1940, 41, or big geopolitical tensions, like the lead up to Gulf War II in 2002. And 1 was due to a Fed rate shock that didn't cause a recession, 2022. That's it. Those are all the 10% drawdowns for the last basically 100 years. Not very many. It's not very many. And the key takeaway is it takes a genuine big shock. It takes a full-blown recession, it takes a war, or it takes a huge policy misstep. Now, one might argue that we're in the middle of the beginning of a policy misstep with the tariffs and other economic issues, but that game is not through yet. So as much as it's super uncomfortable now, just keep in your back pocket the idea that to get a 10% drawdown, crap has to go incredibly badly.
Yeah. All right. I love that message. I think in people's imagination, these negative 10% plus years are more common than what you've actually shown us is the truth. And it's not that we can't be in the midst of one right now. Of course we could. It's that it's not the highest probability bet.
No.
And it almost never is. And by the way, like something really bad has to be happening. And if it's a full-blown recession, that's bad enough. But so I think that's really the salient takeaway. And that's not to say we haven't been in 10% drawdowns a lot of the time. You're specifically talking about years that end negative 10% or worse.
Right.
That's what's really rare.
When you look at your statement, what'd you do that last year? That's the message.
Do we want to touch on this minimum volatility thing just for a brief moment?
Sure.
Okay.
A couple of charts there.
Okay.
So the min vol strategy is one that buys stocks that have lower than average volatility. And there's a couple of popular ETFs that do this. One is USMV, an iShares product. Other one is SPLV, an Invesco product. They're the 2 most popular min vol products. And they're equity products.
Having a good year.
And they're having a good year. So they're up, the S&P's down, and they're actually outperforming, which is kind of uncommon because the goal of the strategy is to get 80% of the upside and only 60 to 70% of the downside. That's what min vol means. So far, we're just outperforming, like forget, the old benchmarks.
Yeah, all of the upside and then some because there isn't any.
Right. So this table shows you how the 2 products go about their business. The USMV tries to hold something closer to the S&P 500 weightings. So put the S&P weightings on the left-hand side, and USMV is modestly underweight tech, discretionary communications because of the big tech names, a little bit real estate, but it keeps a pretty even weighting. The biggest overweight's healthcare, 4.7%. SPLV just picks the 100 lowest vol stocks in the index. And so it ends up with a much more dramatic underweighting in tech and a much bigger overweighting, say, in utilities. So flavors of the same thing.
This is interesting. Look at that divergence in tech weighting. But so these are 2 strategy ETFs specific to minimum volatility, but because of the methodology, one of them is 25% tech, that's USMV, and SPLV is 4.6% tech. That is really interesting. So like now they're both up a similar amount this year, so it hasn't mattered yet. But choose your products, like really, really think about the differences and which one you think is the right version. Even if they both are an identical strategy, the way that they implement that strategy will not be identical.
Yep. SPLV is the older product, so it's a little bit longer track record. USMV came out of iShares, I think, in 2010, 2011, kind of the perfect time for min-vol. So,
Yeah.
but there's a big difference. Let's just roll to the next table. This shows you the top 10 holdings for the S&P, USMV, and SPLV. And you can see, the S&P we all know is Apple, Microsoft, NVIDIA, big chunky weightings. The top 10 are 36% of the S&P. Min-vol also approaches the strategy by saying, let's not be so overweight big names. So the top weighting in USMV is Walmart, 1.7%. The top 10 weightings are 15.7%. For SPLV, the top weighting is Coca-Cola, which ironically you had, we're mentioning just before, 1.3% weighting and a very even kind of structure. It's almost like a min-vol equal rate product.
Yeah, I was going to say they both look equal weight. And then, of course, there's like changes in performance. Like Walmart's had a really great run. So it grows from 1.5 to 1.7. But it looks like in both cases, you don't have any holding that's more than 2% of the fund. That in and of itself, it'll somewhat throttle returns in bull markets, but it's what saves you in an environment like this.
Right. So the message from this is, look, we're all apprehensive about the market. The most important thing in investing is to stay invested in some form. And if min-vol is better for your personal risk tolerance, it's something to consider. And forgetting what relative returns have been.
And then you like the USMV structure better than the SPLV because of its upside capture historically? Is that the main reason?
The main reason is it's closer to the S&P. Those weightings that we discussed, the weightings are closer to the S&P, and I don't like massive vector drift, even for an important style like min-vol.
Yeah, I think if you get a tech rally, you will have less regret in USMV because it's closer to the real weighting of tech in the index.
Right.
I think that, like for me, that would be the big thing that I would pull out here.
Yeah, I mean, USMV did not do great in 23 and 24 because tech was so much the driver, but you still made money.
Okay, let's do some VIX stuff to close out.
Okay.
Walk us through the VIX playbook and why it becomes relevant now.
So the VIX playbook is something that we discuss with our clients all the time. And it basically is a way to look for entry points when calm markets get volatile. And this chart shows you the VIX going back to the beginning of 2023. So basically the entire bull market. 27.3 on the VIX is one standard deviation above the mean. So an unusual statistical observation. And we've only gotten close to that level 3 times or gone through it 3 times since 2023. The first one was when SVB failed. Got to a 26.5 handle VIX.
Yeah, it's 2 years ago this week.
Yes. And the S&P was up 7.5% over the next month. That was a good entry point. Then we had the volatility around the yen rally and the Nikkei flash crash. And the VIX got to 38.6. The S&P was up 2.3% over the next month. And then the last one was that disastrous Fed meeting at the end of last year, where the VIX got to 27.6 and the S&P was up 2% over the next month. So what I tell clients...
I forgot that one.
Oh, I have not.
I totally
forgot. So painful. It was just Powell's worst performance, I think, in the history of his press conferences. Trying to explain that.
If you were on vacation for that vol spike, you missed it. Like if you were out of the office for 2 or 3 days, it came and went.
Yeah, it did. So my message is always wait for a 27 handle VIX close before thinking about buying a market. And I don't know where we are intraday. I think we hit 27 intraday today. We'll see where we close. But that's been a statistically very important level. So, for the moment, be careful. But if you want to buy, think about a 27 handle VIX close before you start buying.
Yeah, a lot of people are trying to play this game right now and not use the VIX, but they're using internals. They're looking for a spike in 10-day lows, 20-day lows. They're looking for some threshold where if you get a certain percentage of the market all hitting 10 or 20-day lows at once, it doesn't completely de-risk whatever, long side trade you're about to make, but it definitely puts the odds in your favor. And I'm seeing a lot of notes going around. And, obviously it probably looks exactly like that 27.3 VIX spike. And those two things probably happen at the same time.
And for good reason. VIX actually measures correlations. When everything goes down, when you make all those 10 and 20-day lows, correlation's high, the VIX is going to be high. That's just math.
All right. What is the likelihood that the market has seen its peak and it happened in February? Just probabilistically, let's run through this for people that haven't seen your research on this topic yet.
Sure. Actually, Jessica mentioned this a couple of times ago, but let's put up her table. This is the number of years that the S&P peaks for the year in a given month. And this goes back to 1980. So for example, in 5 years, the S&P peaked in January, and the average return of those years was negative 18.6. So if you peak in Jan, very, very bad. Thankfully, we didn't do that. So far, we peaked in Feb.
Yeah, we just made it.
We just, literally just by days. There is one example of when the when the S&P peaked in Feb, and it was 1994. And in that year, the S&P was up 1.3%. And then we kind of cascade from there. So generally speaking, markets rally through a year, which is why those peaks in September, October, November, December always have high positive returns.
Yes, much, much less common to see the high for the year in the first 2 months. And if you do, it's usually something very specific is happening. And I think in the case of 94, it was another rate shock.
Yes.
Actually, Greenspan surprise interest rate hike.
Yes. In 1994, the Fed had never actually told people their rate decisions, ever. They just put them out there, and then you had to call a local bank's trading desk to figure out what the Fed had done. 94, there was a rate hike. I remember I was on the sell side at First Boston covering the autos, so deep cyclicals, when this happened. I remember it vividly because for the first time ever, the Fed actually put out a press release saying we're raising rates. And the entire street was like, what the hell just happened? Because A, that's a surprise. And B, if you're putting out a press release about one, there's more coming. So the market instantly corrected. S&P was down 9% through April. It ended up being up 1% on the year total return, down 1% on a price basis. But the market had real problems digesting a suddenly much more aggressive Fed. And I think there's some analogies to today in terms of interpreting what new White House policy means for the economy. So it's a very similar policy shock.
Yeah, I think what Greenspan learned from that episode was to stop speaking so clearly. He never gave another speech again that any English-speaking human being could actually tell you what he was trying to get across. That right after that, his speeches and his testimony in front of Congress, I think they used to call it the Humphrey Hawkins testimony.
That's right.
It just got increasingly more elliptical, and by the end of that period, he speaks like the caterpillar from Alice in Wonderland. It's riddles and palindromes, and nobody really knows what's going on anymore.
Oh, he used to say, if you think you've understood me, I misspoke.
That's exactly right. Nick, this has been awesome. I want to let people know where they can learn more about DataTrek and follow your stuff. So first of all, DataTrekResearch.com is the best place to go to find out more about how you could become a client of DataTrek Research. And of course, Nick and Jessica are on YouTube. It's youtube.com/@NickColas and Jessica Rabe, their full name spelled out. You guys are doing unbelievable stuff on video, and I personally am getting a lot out of it. You having fun still?
Absolutely. It's great.
It's great. It's a grind, but it's highly rewarding in terms of the audience response. They love your stuff.
It really is. And thank you to thank everybody who watches.
Of course. All right. Thanks so much, Nick. We'll check in with you soon, I hope. Much appreciated. Hey, guys, thanks so much for listening. Thanks for watching. We'll talk to you soon.